Welcome to my video on the current account. The current account has four key sections: trade in goods, trade in services, income transfers and current transfers. Income transfers are now known as the primary income, and secondary income refers to the current transfers. So for the purposes of this video, we will discuss primary income and secondary income. Okay, so trading goods is relatively self-explanatory. It's the trade in visibles. So that could be manufactured goods, components, raw materials, energy products, capital, technology. And it should be noted consumer and capital goods. Trade balance in services refers to banking, insurance, consultancy, tourism, transport, etc., education. And these are invisibles, these services. You cannot see them. We then have primary income. This refers to the profit, interest and dividends from investment in other countries. So in a UK context, when Marks and Spencer's makes a profit when operating in, say, Hong Kong, this profit is returned back to the United Kingdom. Marks and Spencer's, after all, is a British company. This will show up as primary income. It also includes net remittance flows from migrant workers. So if a worker is a UK worker is working abroad in, say, the United States, when they send their income back to the United Kingdom, or they send money to relatives rather in the United Kingdom, this will show up as a remittance. In addition, we have secondary income. So secondary income in old money would have been called transfers, current transfers. This refers to overseas aid, debt relief, military grants, UK payments to the European Union. In other words, money is sent to a country or sent to the UK or from the UK, but there is no good or service received in exchange. So let's now look at an example of a real current account. This example comes from the United States. We can see there is the trade in goods at number 3. Number 6 shows the balance on services, the trade in services. And we can overall see balance on goods and services. That totals minus $709. So if you have $816 minus, because you're importing more goods than you're exporting, plus you have a surplus on services, that is, you export more than you import, you will get this deficit of minus 709. The other sections worthy of mention is, of course, primary income and secondary income. It should also be noted that when we consider just the balance on goods and services, this is called the trade account. Now, commonly we may say, well, if exports are greater than imports, we will have a current account surplus. Well, this isn't strictly true, because we have to consider what is happening to primary and secondary income. Therefore, when we're talking simply about goods and services, we are referring to the trade account. Final points. You can see that the balance on the current account is a minus 739. This means that there is a current account deficit. In contrast, we can see that on the capital account, which I will talk about in a second, and the financial account, their totals equal plus 739. Well, minus 739 plus 739 means that there is a balance. So here, there's a financial and capital account surplus. If the current account is in deficit, the capital and financial account must be in surplus, and vice versa. One final point on the composition is this. This is what we are focusing on at AS. All that you need to know for the time being is that this section, the financial capital account, must balance with the yellow, which is the current account. So this slide here is very useful for summarising the sections. So we have the current account, as mentioned, and then we have this section, the capital and financial account, and you can now see what sort of things are included. So for instance, the capital account, we have got patents, copyrights, leases, contracts. We have debt forgiveness, so when wealthy countries cancel their debts to poorer countries. Arguably this doesn't happen enough, but that's another story for another day. We have, for example, capital transfer of ownership of fixed assets, so that might be like properties or something like that. We then have financial accounts. Now this is particularly important for us in the UK because the foreign direct investment is significant. We have a current account deficit that is largely funded by foreign direct investment inflows. For instance, the Shard in London was financed by the Qatari government. Another example of Qatari investment would be Harrods. So we get the point here with regards to the importance of foreign direct investment. Other things which we will come to know in due course, hot money. That's where country investors will take advantage of higher interest rates in countries. So if the UK interest rate were to go up relative to its rivals and say, for the sake of a debate, went from 0.75 to 1.5, well, for every £100 deposit, you no longer have 75 pence return, you have £1.50. So it's likely that people would want to deposit their money in the UK. This one here at the bottom, we've got in red, we've got net errors and omissions. Net errors and omissions is simply there to ensure that the current account balances. So imagine, for instance, if the current account was minus 740, and the financial capital account was plus 739. Well, we can simply say add a further 1 to the financial and capital account to ensure it balances. This is obviously because when you're counting the production of goods and services on a large scale and trades, the numbers are very large. So there will be some error, plus there'll be movements in exchange rates. So this is a rather interesting piece of data. It just shows to you, so I'll highlight this first. This one's talking about services, whilst the one on the right is talking about goods. Well, you can see that as the blue represents the exports, you can see in terms of services, we export a damn sight more than we import. However, the problem is that we import too many goods. You can see this red line here. We import too many goods and we don't export nowhere near enough. The consequence of which the UK runs a current account deficit. It should be added, notwithstanding in primary and secondary income. That is, if we include primary and secondary income, we still run a current account deficit. Now, whenever looking at data, it's always important that we find the zero line. So you can see the zero line here, and you can see that the minus numbers from here to here show that we run a current account deficit. Now, this has been the case since roughly, say about 87 on here. We've had a current account deficit. There's been some periods where we've had surpluses, so you can see, for instance, here that we're above the zero line and here, but by and large, over the last 30-40 years, it's been largely a current account deficit. Now let's look at some of the causes of a current account deficit. Well, the first one is poor price and non-price competitiveness. So if we start with inflation, it may be that we have not managed our demand side of the economy successfully. So it might have meant, for instance, that we're experiencing demand pull inflation. Obviously, if there's higher prices, in other words, inflation, our goods are going to be relatively more expensive than our rivals, assuming that their price levels remain unchanged. The reason for the high prices or the inflation could also be cost push inflation. Maybe a national minimum wage was introduced, or the cost of raw materials purchasing them from abroad has increased. It could be a number of reasons. In other words, the cost of the factors of production have increased. Maybe we have high inflation because we've had inadequate supply side policies. Maybe quite simply that as the economy grew, the supply side policies were not shifting to the AS curve to the right as quickly as AD was moving. Maybe there was too much of a time lag, for example, in building new infrastructure, and therefore the economy overheated and we had demand pull inflation. The point being is inflation has made our goods more expensive. We could also have poor price competitiveness because there's insufficient investment in machinery and research and training. It could be weakness in design, branding and performance. In other words, non-price factors. Although with the UK, I'm not sure this is the case given the prevalence of marketing and design companies in London and across the country. It could be that we're not exporting as much because we have spiced. Strong pound, imports cheap, exports dear, should be relatively straightforward. The point being is that the foreign consumer of our goods is now having to use up, if they're in India, for instance, a lot more rupees to buy the same quantity of UK goods. So therefore, it makes sense for them not to import, say, British, tea or Clark shoes, whatever it may be. So another problem, why there might be a reason for why there's a current account, could be to do with recession in one or more trading partner. So imagine that there's a recession in China. Well, we know there is not a recession at present. The economy is certainly slowing down. So growth is averaging around 6.5% as of 2019, whilst before it was about the 9-10% mark. So imagine it were to slip into recession. Well, if Chinese consumers have a lot less income, therefore they are not going to purchase as many UK products. Okay, so relatively straightforward, that one. Conversely, if their economy is booming, they're likely to import more of our goods. The thing to consider here when looking in the recession on one or more of our trading partners, consider whether it's a major trading partner. Do lots of our exports go to this given country? So, for example, if there were to be a recession in a relatively small country, say like Iceland, it's probably not going to have a huge effect on the UK current account. Another reason could be the UK struggling to sell to emerging markets. Maybe the UK businesses don't have contacts in those countries. Therefore, it shows that the Department for Trade and Industry and maybe the Foreign Office need to come together to improve export opportunities for British firms. Maybe some local guidance, maybe in terms of meetings where they can meet local producers and suppliers, and maybe network with local chains of stores, this sort of thing. Finally, another cause for the current account is to volatile in global prices. Now, volatility in global prices is typical when the supply is inelastic. So you can see here, and this is a micro diagram, that if there's a sudden fall in production, let's say there's a tsunami or something like that, you can see that the price changes massively. However, the quantity is relatively unchanged. So exporters of primary commodities might be hit by fall in world oil prices, beg your pardon, for that reason. We don't tend to produce too much agriculture, a large volume even of agricultural goods in this country. So it's not going to be one of the significant reasons for a current account deficit for us, i.e. that the price goes up for the agricultural good and it's less affordable in terms of foreign people buying our goods. This is more a question for developing countries. Finally, importing nations could be hit by higher prices for oil and gas. This is really important because it can lead to, if the UK, for instance, is purchasing gas from Russia or oil from Nigeria and these prices increase, well, they're an essential input in the production of goods and services in this country. Think about it. Even plastic chairs, for example, or something like nylon requires oil somewhere along the lines in the process. There are some economic problems from persistent, that's continuous trade deficits. Also, I would add to that large trade deficits. So, for instance, if our imports decrease and our exports were to rise, our AD would go to the left. However, that is not the case with a trade deficit. We are importing more than we are exporting. Imports are a withdrawal from the circular flow and exports are an injection. So more imports, fewer injections mean that AD is shifting to the left, therefore reducing real GDP. Real GDP reduces, that means less income for people in the country, they're more likely to be unemployed. Obviously this has an impact on reducing living standards. So we've touched upon that there. So there's a loss of jobs in the home-based industries. There might be particular regional problems. So for example, we could think about, say, the northeast of England and South Wales with regards to, say, coal mining in the past, which was obviously hit by declining exports of coal. And there's obviously the issue of structural unemployment, which I've covered in our unemployment videos. Next problem with a persistent trade deficit, well, it means there's going to be some currency weakness. Think about it. If we're importing goods from abroad, it means we must be supplying pounds. And if we're buying the goods from, say, India, we must be demanding rupees, which means the value of the pound will reduce and the value of the Indian rupee will increase. Sounds great because we're importing the goods, but the problem is then if a firm needs to purchase, say, cotton t-shirts, say Zara needs to purchase cotton t-shirts from an Indian manufacturer, well, obviously that means the cost of production for Zara will rise and it could lead to inflation. In addition, some countries will try to counteract the falling of their currency by buying it up. So, for instance, a famous example of this is China. When China's currency starts to rise in value, they will indeed seek to sell their currency to bring it down. In the case of, say, the UK, if we were to import far too many goods, our currency will do the opposite. It will actually start to fall. Therefore, the temptation would be for the Bank of England and to use up foreign currency such as US dollars and yen to buy up the pound to increase the value of the pound so that import prices don't become too high. The downside of this, we're inevitably run out of these foreign currency reserves. Finally, we've touched upon this. Trade deficit may be a reflection of a lack of competitiveness, both price and non-price competitiveness, caused by ineffective supply-side policies. There will also be problems from running a trade surplus. For instance, if AD is close to full capacity and we get a rising trade surplus in a country, well, inevitably, there's the risk of demand pull inflation. That is, a positive output gap could be created through the overheating, leading to inflation. So, if a country has a persistent trade surplus, this might lead to the threat of protectionism from trade deficit nations. So, for instance, China's got a huge trade surplus, exports a lot of goods to the United States. Donald Trump has responded by putting a tariff on solar panels. China will clearly now find it harder to export its goods to the US. If the surplus is due to low consumption, for example, China again, its citizens tend to save a lot of money, not least because of their culture. They tend to save more anyway than us Westerners, but also because in undervaluing the Chinese yuan, it's making it expensive for the Chinese consumer to purchase American goods. Therefore, it could be suggested that there might be a fall in living standards because they cannot afford to access goods and services from abroad. Finally, surplus might be a result of exporting high-priced commodities. So if you are Uganda and you're, benefiting from extremely high tea prices, well, that's great in the short run. But we've seen earlier in this video that if there were to be some sort of supply-side shock or simply a poor harvest in the country for tea, supply would shift to the left, and therefore the price goes up for the Ugandan tea, and the Ugandans will get more export revenue, which sounds great until you have a perfect harvest. And if the perfect harvest shifts supply massively to the right, you can see that there'll be a huge fall in the price. Because there is a huge fall in the price, and because the demand for tea is likely to be inelastic from consumers in the UK and other large tea drinking nations, Uganda's actually going to experience a fall in export revenue. If the export revenue falls, and remember, there's not a lot of consumption going on in developing countries, it's going to lead to a lot less injections into the circular flow, a huge shift of AD to the left, and a negative multiplier. Policies to reduce a trade deficit. Well, we have two types. We have the demand side policies. These are short run policies that aim to influence AD. So for instance, if we tighten fiscal policy, in other words, the government spends less injections, and taxes more withdrawals, AD will go to the left. Likewise, if with monetary policy, if we were to raise interest rates, consumption would fall because the cost of borrowing has increased. Investment will also fall, not least because consumption and investment are entwined. The result, AD will shift to the left. This will mean the price level decreases and people within the country will purchase more domestic goods. Also, the lower price level in the country, as shown here, the lower price level in the country, so I'm talking here now, will mean that our goods are now more price competitive abroad, so we're more likely to export the goods, meaning that AD could actually end up shifting back to the right. There could be a policy to reduce the exchange rate. So if we lower the value of the interest rate, there's going to be less inflows of hot money into the UK. There will be more outflows of hot money from the UK. Consequently, the value of the pound will fall. If you're unsure about the exchange rates, check out my video on the topic. The other policy we can have are supply side policies that aim to improve labour productivity and invest in human capital. These have the effect of shifting AS to the right. and therefore the price level will indeed fall from, say, P1 to P2. Now it should be noted that I don't in the videos always label the diagrams and the equilibrium. This is essential, however, that you do it. It is essential that you do it in the examinations. Finally, we could also implement protectionist methods such as tariffs, that's a tax on imports, or quotas, which is a physical limit on the number of goods coming into the country. This should limit the number of imports. Good news, because it should improve our current account position in the short run, although to what extent is debatable, given that the countries upon which we levy these import duties on the goods we import from them are likely to respond in kind, that is, retaliate. So here are some reasons for the UK's persistent trade deficit. Well, the first one is that we have a high income elasticity of demand for imported goods and services. Therefore, if our income increases by 1%, we are demanding, say, 3 or 4 or 5% more imports. We are simply much more likely to purchase imports when our income increases. The second reason is there might be problems with our supply side. It's suggested we spend too little on research and development, and we don't invest enough in capital stock. So therefore, AS is not shifting as far to the right as it should be, and our price levels are not as low as they should be, meaning our goods are not competitive on world markets. This could be linked to this point here regarding the financial crisis and credit squeeze. Obviously, during the financial crisis, we had a problem with bank lending. Therefore, if businesses could not access the credit to expand their businesses, well, how were they ever meant to meet an increasing demand for exports? Remember, there was a low interest rate, so the value of the pound fell, and in theory, at that point, UK businesses should have been increasing their exports. In other words, they didn't have the capacity to meet the proposed extra demand. Finally, it should be pointed out that many British exports go to slower growing countries. So if those countries are stagnating or not growing particularly quickly, well, it's unsurprising that we're not going to be exporting a whole lot of goods to them. So on this slide, you can just pause this and have a look at the indicators to judge competitiveness. I think this is relatively self-explanatory, so just take a second to have a look over these. In terms of the UK, you can see how competitive we are. Now, this is for 2014, so a little while ago. In terms of global competitiveness, we were 9th out of 144 countries. So in other words, there were only 8 countries who were more competitive than us. You can see from the diagram, the spider web here, okay, that the UK has particularly good infrastructure. So we were 10th out of that. There's the infrastructure. You can also see that we were particularly good labour market efficiency. So we move workers between jobs particularly well, and the workers are relatively skilled at that. So you can see we're here. In terms of technological readiness, we've got good infrastructure, although some people with slow internet speeds would probably contest that point. There we are. But the point being, overall, you can see that we are closer to the outside of the circle, the spider web, than most of the advanced economies in the world. So you could argue that our supply side policies are not as poor as first claimed. On this slide, I've highlighted the importance of unit labour costs. Unit labour costs are total labour costs over output. Now, to note here, if we were to put, you could plug in some numbers if you so wished. Let's put that equals ULC. But the point being is the following. If our total labour costs fall, for instance, we remove the national minimum wage, we reduce national insurance contributions, etc., this would mean that we would have a lower number on the top. If output were to remain unchanged, the unit labour costs would increase. Supply side policies can attempt to reduce the labour cost, i.e. the top one, or they can attempt to increase output. So imagine the total labour costs remain unchanged. If the total labour costs remain unchanged and output were to increase because we might have had some extra money spent on capital stock in training, therefore worker capital productivity increased, this would mean that unit labour costs would be falling. Put simply, you are going to show when unit labour costs fall that AS is shifting to the right. So here's some terms about the balance of payments, some key terms. Again, pause the video and have a quick look at these, particularly useful terms used. And we've got here the meaning of deficit and surplus on the current account. Well, I think we've discussed that in a fair bit of detail. Thank you for listening to my video.